In this week's video, we'll review the latest charts and data sets to help us answer the question, will CPI deliver a knockout punch for stocks? We'll be moving quickly, so feel free to use the pause button on your video player. This year has been among the worst, if not the worst, in several generations for diversified investors. The last month only served to make things worse. Investors are in a difficult situation, and the Federal Reserve may find themselves in an even more difficult situation relatively soon. This Bloomberg piece here talks about the level of interest rates that can cause financial instability relative to the level rates need to go to deal with inflation. We've got a bad combination here. Interest rates have risen extremely rapidly, and we have a lot of debt in the system. So we have to be mentally prepared for something breaking in the financial system, and we have to be mentally prepared for the Fed potentially to be forced to pivot in some way. We still have numerous volatility measures that are telling us the bear market may have further to run. Now, financial conditions are tightening, and that's not really any surprise. This is exactly what the Fed wants to see happen. And if history is any guide, there's a good chance that we'll see credit spreads widen significantly before all of this is over. Still a lot of concern relative to leveraged loans. Recent events had some market participants earlier this week hypothesizing that the Fed was about to pivot. Remember last week the Bank of England stepped in. Early this week the UK scrapped some plans relative to income taxes that the bond market wasn't particularly fond of. The UN did something extremely rare, telling central banks to back off. And then Australia, the Australian Central Bank, surprised the markets by a much lower than expected rate hike. With many believing these events would force the Fed to pivot, we had an enormous rally on Monday and Tuesday of this week. And those back-to-back moves were extremely rare, similar to these dates here and similar to dates identified in this tweet here. And we would think that a move like this and a move like this back-to-back would be extremely bullish, and it can be from a longer-term perspective. However, the maximum 6-month drawdown relative to the dates identified here and here, the average drawdown was 15.8%. In 78 calendar days, the median drawdown was 12.2% over 57 calendar days. And notice, the drawdown typically occurred before the gains in almost every single case with the exception of 2, telling us it was possible that this was going to be reversed in relatively short order. This helped us keep an open mind about worse than expected outcomes after the 2 days. On the other side of the coin, a little bit more favorably, Sentiment Trader identified 3 signals relative to Monday and Tuesday of this week, and historically, really good things tended to happen looking out 1 year. If we looked at the 1-year drawdowns relative to the dates that Sentiment Trader identified, and if we put them on a 2022 chart, it gives us some reference points. So when we wake up on Tuesday morning, we've had a massive gain on Monday, and the futures are up big on Tuesday morning. So what you want to do, you want to logically think through the following question. Why would I want to put some capital in harm's way? So there's 3 things that can happen. We can have a new bull market that began on Monday morning of this week. We could be in another counter trend within the context of a downtrend, or the bear market was going to bring lower lows in relatively short order. If you think it through logically, all 3 of those scenarios are tied to inflation and the Fed. And even when the markets were rallying strongly on Monday afternoon, the Federal Reserve at 3:10 Eastern Time on Monday started to deliver a very consistent message to the market saying, if you believe we have pivoted or we are about to pivot, that's not the case. Speaker after speaker delivered the same message this week. So while we're getting to a point where bonds are starting to look attractive from a long-term valuation perspective, if interest rates are still rising, that makes investing in bonds very difficult. Now, from this thread, the ongoing bear market scenario is based on inflation that remains too far above the Fed's 2% target, forcing them to remain in hawkish mode, eventually hitting the economy and earnings. Well, a big driver of inflation is wage growth. In the strong labor report on Friday, told the markets that most likely the Fed still has a lot of work to do. Fed really doesn't want to see things like strengthening wage growth, nor are they looking for data that's in alignment with statements like this. This is consistent with a very tight labor market. And as a result, during the day on Friday, the market, from a probability perspective, a week ago had about a 56% chance of a 75 basis point hike in November. That jumped all the way up almost to 80% on Friday. And maybe more importantly, relative to the terminal rate, where the market expects the Fed to pause or stop raising rates, if we look at odds all the way out to December of 2023, so more than a year from now, the odds of being up in this area here between 4.5% and 5.25%, especially in this window here, 4.5 to 5, were higher Friday than any time looking back over the past 4 weeks. We've got an extremely important CPI report coming out next Thursday. The Federal Reserve Bank of Cleveland publishes estimates of CPI. These are the numbers from last month here. CPI year over year last month was 8.3%. The estimate from the nowcast, a still elevated 8.2%. The Street's forecast is a little bit tamer. We'll just have to see how it plays out next Thursday. This allows you to compare last month over here to the estimates from the Cleveland Fed over here. In this segment, we'll be addressing 2 questions. Is it logical to think the bear market could be over in stocks? And are there any reasonable places to park money other than the money market fund to try to get a better return? Given inflation is our problem in the present day, it makes some sense to compare the present day to the high inflation period of the 1970s. The chart here, 1973 here, 1975 here. It's a daily chart of the 10-year yield divided by the S&P 500 index. This is the massive and painful bear market in 1973-74, very similar to the financial crisis and the dot-com bust relative to the magnitude of the decline in the stock market. This tells us what we might be looking for when the bear market is over. S&P 500 bottoms here in October of 74 and then has a retest in Q4 of 74. You can see in this window here, the ratio of the 10-year yield relative to the S&P 500 starts to weaken noticeably. And then when the stock market really starts to move, the ratio starts to drop noticeably. In the present day, what we're really asking is, how does this compare to the post-low look in the S&P 500 and the pre-low look in the S&P 500? And it's probably fair to say, since the ratio is above all of the moving averages on Friday intraday, the slopes are up, blue the fastest moving averages on the top. This is a full-bore bullish look for the most part. Probably fair to say we look more like this period in here relative to the rollover look in here. When we talk about interest rates, it's almost one and the same relative to the strong dollar. Strong dollar speaks to interest rate differentials. You could possibly make an argument that this point here, making a new high and then red moving away from the moving average cluster, you can make an argument it looks a little bit like this point here, and unfortunately, this is where the bear market really accelerated to the downside. The takeaway really is, the more this chart on the right looks like this period in here, the more concerned we should be. The more this chart starts to morph into something like this, the more confident we should be from a probability perspective relative to the S&P 500 possibly putting in a low. Probably fair to say this doesn't look like the bear market's over, and it's fair to say from a historical perspective that the VIX isn't saying it looks like the bear market is over. Now let's look at the same ratio and the same comparison, but this time let's do it on weekly charts. This is really what we want in the present day. This is the low here in 1974. This is your retest of that low in late 1974. Right off the bat, this is a higher low relative to this low. We've made a lower low, but it's fair to say this still looks like a retest. But if we come over here, RSI during the retest process is hanging around 50, and then when the market really starts to take off, it drops below 50. We really don't have anything like that in the present day. On Friday, October 7th at 2:33 p.m. Eastern Time, RSI was at 75 on the weekly chart. Similar situation here. If you want an S&P 500 low and you want a successful retest, this is what momentum on a weekly basis looked like. You get a bearish cross. That makes sense. The momentum for this ratio rolls over. It's not what we have in the present day. In fact, it looks like momentum for the ratio is picking back up. Also noteworthy, technical analysis far from perfect. Here, earlier in the year when we had the breadth thrust, this looks a lot like the bottoming process in this period here. This is one of the reasons why we were redeploying capital in this window here. Never speaks to certainties, speaks to probabilities, and the same thing is true about the comparison from here and here to here and here. Since our main fundamental driver revolves around inflation, the Fed, and interest rates, if rates are going to calm down, then bonds are going to have to calm down. A lot of talk right now that tips may be a good place to put some money, and that very well may be the case very soon, but we're still dropping here. The good news would be this A to B move from here to here, we are at the 50% retracement. We'd like to see some type of bounce and something that looks like a trend reversal in this area here. And TIP has moved from 122 all the way down to about 105. And in this window here from November of 2021 to this week, down 14.36%. In terms of looking for some safer places or a place to park some of our capital to improve our returns, we'd really want a look like this in tips. So we do have the oversold look in the present day. We'd really like to take on a look more like this, like this, like this, or like this. We're just not there yet, but we are at a stage where it makes sense to pay attention with an open mind. Similar situation on the monthly. We have the oversold type look. We'd like to see this over here and price here morph more into a look like this. We don't have it yet. It's possible it could come sometime in the next few weeks or months. From a trend perspective, very, very difficult to stand in front of this waterfall decline at this point. This is TIP, the ETF. This is the 8-day moving average in blue all the way out to the 250-day moving average. And it's pretty easy to see we have a full-bore bearish look. That would be the bad news. The good news would be this is an extended trend look, telling us to keep an open mind about a potential reversal. Looking for places to possibly park some of our capital. All of these charts take short-term corporate bonds and compare them to other alternatives. 3 to 7 year treasuries, 7 to 10 year treasuries, long-term treasuries, tips, high-yield bonds, and the S&P 500 index. You can see for the most part in every case, SPSB appears to be unquestionably the better alternative from a trend perspective. A fair question might be, why don't we own some of this? Because if we look at it in isolation, it recently made a new low for the year. It's another instrument that we're watching, looking for some improvement. Haven't seen enough yet to do anything. We've seen enough to pay closer attention. Let's check in on the 20% drop model. You may remember conceptually, the 2022 market could check boxes for this signal and this signal. These are two signals over here, so some of the dates overlap. Duplicates are knowns. When this and this happen traditionally, historically, really good things happen looking out 1 year. However, in the 2008 case, the drawdown was extremely painful. Thus, this model was created to help us assess the probability of a successful bottoming process. And you may remember that scores go from 0% to 100%, and back on July 8th, we were floating near zero. August 5th, we got into the 20s, and by August 16th, after the breadth thrust, we were able to check about 51% of those boxes. As you might imagine, if we're going to put in a successful bottom as of October 7th, there's work to do. That doesn't mean that this number can't go back up, but we need to see that. Dow advanced decline line into potential resistance during the 2-day move this week. Longer we stay below this area here, the more concerning it becomes. Intuitively near a major low, end of the dot-com bust 2003, 2009, 2010, early 2012, late 2011, 2016, after the Christmas Eve low, 2018, and the COVID low, this line turns up, flattens out, turns up, turns up. We just don't have that yet in the present day. This is as of October 6th. And of course, this data did not improve on October 7th. S&P 500 up-down volume looked very, very good in August here. Now this looks like a failed breakout and potentially a breakdown. If we get into this area here, you can see we had moves from A to B as a possibility. Using a similar indicator for the NASDAQ 100, the indicator's been down here and into this area here. Still have this extremely vulnerable look, but thus far, Bitcoin's held up. You can make an argument that's your left shoulder, that's your head, somewhat of a right shoulder look in here. Much like most of the major stock indexes that are still really in retest mode, this is still in consolidation mode here, vulnerable but hasn't broken down yet. It's hard to make an argument that if the market thought interest rates were about to peak, that this ratio would look like this week. This is the NASDAQ composite. This is volume by price and the way up. The band of potential support between 11,400 and 10,800 during Friday's session under 10,800. So in a vulnerable spot, much like this look here. Still holding potential support in these areas for now. Similar situation here. Vulnerable, but still some basis for patience. And when I say a basis for patience, that means relative to taking additional defensive steps, in addition to the ones that we've already taken. If you're a stock market bull, this is not the weekly look you want. You don't want this type of look. You can see we're on the wrong side of that 200-week moving average. NASDAQ weekly, after the big push higher on Monday and Tuesday, the weekly chart up 5.68%. We gave back a lot of that before the end of the week. In fact, on the weekly chart, the NASDAQ closed below the first print of the week. We closed slightly below the weekly open, meaning if you bought during the regular session this week, for the most part, you finished the week at a loss, despite the fact that the market gained 5.68% intra-week. That's what this black weekly candle is here. The black means you close below the open. It's really not what you want to see here at this 200-week moving average, and you don't want to see momentum rolling over like this. Similar situation here. On the wrong side of the 200-week, this is a concerning momentum look that we've been highlighting for several weeks. Many markets have potential support relatively close by, so we want to keep an open mind about a wide range of outcomes. Dow Jones Industrial Average during Friday's session. Here's an area of potential support, an area of potential support. It's in relative close proximity. If we don't hold there, it starts to open the door down into this area here. That's about a 10% drop from where we were during Friday's session, and this would represent about a 15.8% drop down into this area here. Probably not the look that you want to see if you like tech stocks or if you're hoping that interest rates have peaked. During Friday's session, still in close proximity to the recent lows here. Some potential support here if we break down. Still have that concerning volume by price air pocket look in here. Somewhat of a mixed bag here, concerning air pocket look, but you also have potential support relatively close by on the weekly chart. During Friday's session, October 7th, you can see the NYSE composite below that original June low here. There's only two times on this chart where you're touching the lower Bollinger Band, in here and in here. Still holding potential support here. If we don't hold, that's concerning. But this chart on Twitter earlier in the week basically said this is potential resistance here. Thus far, it's still acting as resistance. S&P 500, 2005 to 2008. This is the major top financial crisis bear market. This is similar to the move that we saw intra-year this year where we failed near the 200-day moving average. You can make an argument we're somewhat in this area here. You can see the 50-day moving average in blue rolling over. It's also noteworthy that this is potential support over here. And in this anecdotal case, for the most part, we just blew right through it eventually. Now, this is concerning. This is S&P 500. This is daily momentum, weekly momentum, and monthly momentum. They all seem to be potentially converging. Don't have the cross here yet, so there is some hope for this level to hold. This isn't a good look. You pop back above this gap area here, and then we popped right back below it. If you're a stock market bull, you really wanted the weekly chart to hold in here. It hasn't thus far. If you can move up relatively rapidly, it's possible to fall relatively rapidly. There's a gap here from the COVID drop. That gap, of course, was eventually filled, but it can still be relevant. You can see it was relevant, this price area in here. A lot of this cluster in here comes in somewhere in the neighborhood of 3,300. Not a forecast in any shape, form, or fashion, simply reference points. S&P 500 daily, it wasn't particularly encouraging after the big moves here that the S&P stalled at a downward sloping 20-day in blue. It's another stall look here. You see the breakout and the recent pop higher. We weren't able to get back above the trend line on high yield bonds. The big rally on Monday and Tuesday really went back to the first area of potential resistance and thus far could not clear that resistance. As always, we're making statements based on the chart in front of us. We're not predicting whether we're going to be in this area next or down here next. Right now, this is a concerning look. This daily S&P 500 here, this is Williams %R momentum. This is known as a momentum failure when the market tries to rally as it did earlier this week, but you can't get back into overbought territory. It just says you're vulnerable to more downside. In terms of reference points in the S&P 500, a lot of areas of potential support between 3,200 and 3,400. It's possible we could move relatively rapidly in this area here, but it doesn't have to play out that way. We could hold here and rally in this direction. At the end of August this year, the S&P 500 was down more than 10%. Historically, the additional drawdown hypothetically would take you close to, this is the average and median drawdown in the historical cases, near 3,200. S&P was down 5% or more at the end of April. Similar situation, it would put you in the middle of that cluster hypothetically and somewhere around 3,400. We've been concerned about this look here. This still doesn't look good. You can see now blue, the fastest moving averages on the bottom, and the slopes of all of the moving averages are down. So why do we look at a chart like this and potentially give price the benefit of the doubt when we have this clear major topping pattern look here in 2022? Because a major topping pattern speaks to probabilities. Here's a clear major topping pattern here in 2013, 2016. We did break down here, made a lower low, and then we rallied. Notice the 50-day moving average here. When good things happened in blue turns up. Here's the slope of the 50-day during Friday's session here for the S&P 500. Here's the slope of the 50-day moving average for the equal weight S&P 500, both of them on Friday, October 7th. This really doesn't look anything like this at the moment. Here is the S&P 500 equal weight. You can make an argument that's your left shoulder, that's your head, that's your right shoulder. Hypothetical target, take you down into this area here. NASDAQ's already been in this area in 2022. And you can see ARKK has already been in this area in 2022. And as always, all of these charts, none of this, not a forecast in any shape, form, or fashion. Just trying to understand a wide range of possibilities and assess probabilities. Thus far, the 10-year yield has been holding above potential support here. During Friday's session, 2-year yields, which are typically tied to expectations for Fed policy, up. Got a long-term breakout. This chart here goes all the way back to the 1960s. This is the 10-year yield. S&P 500 was rejected at its 20-day moving average this week. The 10-year yield bounced at its 20-day moving average. This is what a successful rally attempt looked like in the stock market, looking at 2-year yields because they came down. This really doesn't look similar in its present form. Trend lines tend to be very arbitrary in nature, but this sure looks like a break of a trend line and then a retest of the break, and now we're moving in this direction. All kinds of potential support in here. ARKK, the trends really not looking particularly favorable here when you look at the moving averages. This is Apple around 12:30 p.m. Eastern time on Friday. These are not encouraging looking candles, and you can see momentum here on the weekly chart. This is not what you want to see. Momentum's rolling over, tried to recapture the zero line, and now we're below it on Friday. Amazon in isolation here. This is weekly, below the 200-week moving average that appears to be flattening out. Longer below, the more relevant it becomes. Longer below the trend line, the more relevant it becomes. Longer below here in terms of MACD, the more relevant it becomes. The longer price remains below all these moving averages, the more relevant it becomes. It's a way of always reinforcing. We're not extrapolating. We're not assuming that this chart is going to go in this direction. It just doesn't look good today. We'll see how it looks tomorrow. Talked about leveraged loans stalling in an important area. It's a 200-day moving average in orange. Physical gold relative to the S&P 500, the ratio is back above that 200-day in orange. Like a lot of the charts in this area here, very encouraging, retaking this area. Look here in August. This is a concerning look in here. A lot of white space in this area. Fast move in this direction, it's possible we get a fast move in the other direction. That's all to be determined. Corporate bonds, if you're a stock market bull, you'd really like to see some improvement here, maybe some leadership, some bottoming before the stock market. Here's a gap up, COVID in here. We recaptured that, and it's troubling now that we're below it during Friday's session. This momentum's not particularly encouraging either. Many stock indexes in the United States recaptured the June low this week. LCD was unable to do that. Again, you would think if interest rates were getting ready to peak, that QQQ relative to SPY would be positive for the week. It's down 0.83%, around 12:40 p.m. on Friday. This is also an inflation-type interest rate ratio, QQQ divided by XLE, making a new yearly low during Friday's session. This doesn't bode well for inflation and rates with this tight look in here. Still retesting this low, so good things can happen still. In mid-caps here, the 50-day rolls over, bad things happen. The 50-day rolls over, bad things happen. It's rolling over again in the present day in a vulnerable area. No question, inflation expectations have been coming down. Maybe we'll learn something this week with CPI. This seems to be an important area in here. Momentum looks like it's trying to turn back up a little bit, but still below 50 here on RSI. This is vulnerable weekly momentum on Tesla, turning down near the zero line on MACD. These are 50-day moving averages for Meta, Tesla, Amazon, Alphabet, Apple, and Microsoft. The term vulnerable comes to mind. If you're a stock market bull, you really don't want to see a look like this or this. There's another one where you can place that vulnerable tag. And you can place the same vulnerable tag here. We know interest rates and inflation and the Fed are a problem for the markets. And we know, all things being equal, tech likes lower rates and not higher rates relative to discounted cash flows. Thus, from a relative strength perspective, we'd prefer to see tech bottom, show some strength before the S&P 500 because it can speak to rates, inflation, and Fed policy. Here's an area to watch in the coming days, potentially. Talked about this before, not a particularly encouraging look. Got that big CPI report coming on Thursday. We have to be open to more downside in the stock market until the evidence starts to turn in a material manner. That may happen very, very soon. Hasn't happened yet. Our objective is to protect capital, try to grow it in a conservative and prudent manner until things start to improve. History says that will happen, and on the other side, it most likely will happen in a big, big way. We're just not there yet. Sum things up. Still near those June lows, the retest process still underway, still vulnerable, but still underway. We have that concerning momentum convergence look. Showed it using daily and weekly and monthly charts for the S&P 500. And since we're vulnerable, the bulls need something good to happen this week, and maybe it will. Maybe it will be CPI. We're still hanging around. As you saw on Friday with the monthly labor report, we're in an event-driven market. And just like you saw this week, we covered this bullet point last week, that things can happen fast in both directions. That's exactly what we saw this week. And that typically is associated with bear markets, but it can be associated with a bottoming process. If you want an example of that, go look at the 2011 low in October of 2011. There's a lot of volatility between that low and year end. We talked about this for several weeks. It's still a concern, and it may force the Fed to pivot. If that doesn't happen, most likely they're going to try to stick to the 1970s script, which means they're going to err on the side of knocking out inflation. There's no question some inputs on inflation have already started to ease. It's possible we could see that in CPI this month. It's possible it won't happen until later this year or early next year. Until the bear market looks like it's over, we're going to be looking for opportunities in other places. It's just very, very difficult to find them right now without putting our capital in harm's way. It's very, very important that we head into next week with no assumptions about CPI and no assumptions about whether or not this retest is going to pass or fail. We're still near the June lows, and thus we all know the only way any of this is going to work. So we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.